You were told that a six-figure salary was the finish line, that you had made it. But for the majority of Americans earning $100,000 today, it just means that you're keeping your head above water. On paper, the economy is stronger than ever. In reality, the cost of living has climbed faster than paychecks ever could. To match the same middle-class life your parents could afford on a single income in 1985, you would now need about 62 weeks of work in a year. The middle class didn't disappear, it just started living on time it doesn't have. Chapter 1. The 62-Week Year. The American dream used to have a simple definition: work hard, earn enough, and you can afford a stable middle-class life. But the question is whether that definition still holds. Economist Oren Cass and his research group, American Compass, developed something called the Cost of Thriving Index to test exactly that. The idea is simple. Take one family and one basket of basics, and then ask how many weeks do they have to work to pay for the items. The basket covers groceries, a modest home at the 40th percentile, family health insurance, and a car for work. Then add in college for the kids on top of it all, and that's the base of an ordinary American life. In 1985, the answer was about 40 weeks. The average middle-class American paid for all of it and still had a fifth of the year left over. That leftover turned into savings, into a down payment, into a bit of breathing room for a bad year. By 2022, the same basket swallowed 62 weeks of pay. It now takes 14 months of work to buy 12 months of a normal life. The shortfall is not bad luck or a rough patch, it's baked into the system. There's a cruel twist buried in the wages. That 1985 worker earned about $443 a week. His 2022 replacement took home about $1,200, nearly triple a paycheck. On paper, he looks 3 times richer, but the cost of basics rose faster than the raise ever could. The bigger number now buys a smaller life. A single income used to carry a household. Now it takes 2 paychecks to barely buy what one used to. The American middle-class family added a whole second earner and stayed in the same place. So when a household looks fine, something is usually holding it up behind the scenes. It might be a second job, or overtime, or gig work after the kids are asleep, or a credit card filling in the gap. None of that is a choice anymore. It is how people survive. You might think this only affects a small number of families. It doesn't. In early 2024, the research group Payments found that 48% of households earning over $100,000 a year live paycheck to paycheck. It doesn't stop there. Roughly 36% of households earning over $200,000 report the same thing. These families are known as Henrys, high earners not rich yet. They hold the salary their grandparents would have called a fortune. Behind it sits drained savings and a retirement fund that keeps sliding away. They do everything their parents did. They follow every rule they're told, and they're still losing ground. So if the people at the very top are going under, who is this booming economy actually booming for? Chapter 2. The GDP Ghost. The booming part is not exactly a lie. The economy grew around 2% in 2025. Unemployment stayed low for a long stretch, and the S&P 500 kept hitting record highs. By those readings, everything looks healthy. The trouble is what's left out. Think about what actually matters. GDP tracks output, the total dollars of goods and services produced. It tells you how big the economy is, not how far your paycheck goes. Unemployment tracks whether you have a job, not whether that job lets you afford rent, food, or basic stability. Both are useful indicators, but neither answers the question that people actually live with. Does working full-time still cover a normal life? A lot of what we call growth is just the staggering cost of standing still. A lot of the jobs being created sit in the service economy. Walmart, the largest private employer in the country, employs roughly 1.6 million Americans, but the wages in those roles don't keep pace with rent or health insurance costs. Since the late 1970s, a typical worker's pay has risen about 14.8%. The output from each worker has risen about 64.6%. CEO pay over that same stretch jumped over 1,300%. There's a huge disparity between those doing the work and those reaping the rewards. Economists sometimes describe the pattern after downturns as a K-shaped recovery. One line rises for those who own the assets. The other drifts lower for those who rely on wages. The same economy, two very different trajectories. So the economy keeps growing while the family budget shrinks. People feel the gap even when they can't name it. For years, they have told pollsters the economy feels rough, and the data keeps insisting they're wrong. Writer Kyla Scanlon calls this gap a vibe session. It's the distance between how the economy looks on paper and how it feels at the kitchen table. Surveys from the University of Michigan have tracked that mood staying weak for years, even as major economic indicators continue to rise. That disconnect isn't random. It reflects what those indicators measure and what they don't. GDP and unemployment are useful tools, but they don't capture the cost of holding a normal life together. Rent, healthcare, groceries, and everything it takes to stay stable month to month. So the numbers move on charts and headlines, but they don't always match what people are actually feeling. Chapter 3. The Big Four. You've been told you're richer than your parents because your things are better and less expensive. The television is huge. The phone in your pocket could outperform a 1985 supercomputer. Economists even adjust inflation figures for quality changes in products. It's called hedonic adjustment because a phone or a TV today is better than one from 10 years ago, but in real life that improvement doesn't always translate to feeling better off. You might be able to afford a large 4K television. What's harder is affording the space to live comfortably around it. Because the biggest shift hasn't been in gadgets, it's in housing. A home used to cost about 3 times a household's annual income. In many cities today, it's well over 5. Take Austin as an example. The price-to-income ratio reached about 5.75 in 2022. By mid-2025, it had cooled to around 4.31, but that is still above its long-term average of roughly 3.9. And the barrier isn't just monthly payments. A 20% down payment on a median home can mean around $80,000 up front. That's money most renters can't save while covering rent and daily expenses. After the 2008 crash, the Wall Street firm Blackstone moved quickly to buy up foreclosed homes at scale. It later built a company called Invitation Homes, which at its peak managed roughly 80,000 properties. Another major player, Progress Residential, grew to around 97,000 homes. In Atlanta, big investors at one point owned close to 25% of all single-family rentals. The starter home stopped being a place to live, and it became a return on someone else's money. Childcare is another drain on the middle class. The federal government calls childcare affordable at 7% of your income, a bar almost nobody clears. The average cost runs over $13,000 a year for a single child. For 2 kids, you are past $26,000, more than many Americans earn before taxes. In an expensive metro, 2 children in care can eat 30 to 40% of a $100,000 salary. In 45 states, it now costs more than the average mortgage. In 38, it runs higher than in-state college tuition. Then there's the problem of healthcare. In 2024, the average family plan was close to $25,600. By 2025, it was $27,000. Employees cover roughly $6,300 of that straight out of their paycheck. Over 5 years, those premiums jumped 24% while wages lagged behind. Most of the country can't get to work without a car either. By 2025, a new car payment cost around $750 a month. The insurance alone topped $2,000 a year before a drop of gas hit the tank. The system doesn't feel like it's breaking, it already has. Chapter 4. The Debt Illusion. America's middle class is living on borrowed money. By late 2025, credit card balances hit a record $1.28 trillion. Add on about $1.66 trillion in auto loans and another $1.65 trillion in student loans, and household debt reached $18.59 trillion, another all-time high. The mortgage sits on top of all of it. The strain is starting to show in places it shouldn't. In 2025, more people in their 60s and 70s fell behind on their credit cards. It was the worst rate seen since 2001. A warning sign. The people who were supposed to be safe are being caught in the economic trap. The detail that matters the most, though, is what the borrowing really buys. Roughly 60% of cardholders now carry a balance month to month. In one recent survey, 55% said the balance exists to cover essentials: the groceries, the gas, the stretch between the paycheck and the rent. When most credit card debt is used to cover basic necessities, it stops being a story about overspending. It becomes a signal of something deeper, a gap that no ordinary income was designed to close. The debt isn't sitting on top of savings, it has taken its place. After that, the interest goes to work on whatever's left. At a rate near 20%, a $5,000 balance can cost $1,000 a year just to carry. That is money that buys nothing but time. That's why one bad moment can tip the whole thing over. A medical bill, a sudden layoff, a car breakdown. The line between a stable family and a missed payment has blurred. Chapter 5. The Doom Loop Algorithm. For a long time, people judged the economy locally by their job, their numbers, the street they lived on. Now it comes from social media feeds, where posts are ranked by algorithms. Those feeds have an agenda. They don't show everything equally. They prioritize what keeps people scrolling, and uncertainty tends to hold attention, so the algorithms push the scariest posts to the top. One day, it's layoffs at Meta and rounds of cuts at Google. The next, it's someone crying in a parked car after Amazon let them go. One bad week at one company starts to feel like proof of something bigger. It's known as money dysmorphia. It's the gap between how well you are doing and how broke you feel. It widens every time you scroll. Fake wealth sits on one side of the screen, doom on the other. Almost nothing in between tells you what normal even looks like anymore. This design is deliberate. A clip of a $400 grocery run pulls in millions of viewers. The story about a steady job pulls in none. The system shows you the panic and the fear and buries the ordinary and the mundane. You start to believe that everyone is broke and you are next in line. It's easy to dismiss all of this as a phone problem. But that misses what's actually happening. This isn't just about distraction, it's about how the information about the economy is now filtered and amplified at scale. Public perception of the economy often doesn't match individual financial reality. People can feel better or worse about conditions without their own income or bills changing. You can see it most clearly after elections. The same set of economic conditions is interpreted very differently depending on who's in office. The underlying numbers haven't shifted overnight, but the way they're talked about and felt often does. And even worse, it's a feedback loop. Confidence is not just a reading of the economy, it shapes the economy. When enough people brace for a crash, they stop spending, they delay their purchases, and they hoard what they have. The slowdown they feared starts to come true. The genuine cost pressure feeds the fear, and the fear feeds the content. The content blows it up larger, and at every turn the platform takes its cut. The feed determines your mood, sells it, and then hands it back to you as news. And it all traces back to one place. Chapter 6: The Financialization of Survival. The things people need to live have increasingly been turned into assets that generate returns for someone else. Housing is the clearest example. It's no longer just shelter, it's also an investment that only works if prices keep rising. And rising prices means it becomes harder for the next person to afford it. Wall Street firms and big pension funds pour money into the housing market to fund someone's retirement. But it's not yours. College took the same path. Loan servicers like Sallie Mae and Navient collected on student debt for years. Schools get paid up front while the student pays it into middle age. Even the private equity money kept hunting for more, buying up apartment buildings, mobile home parks, and hospitals. Every aspect of our lives is being squeezed for profit. Bright Horizons runs childcare as a publicly traded business under the ticker BFAM. United Health, the largest health insurer in the United States, generates some of the highest profits in the entire healthcare sector. What used to be a nursery and a doctor's office now operates at scale as part of the revenue side of the economy. Workers keep producing more each year. The reward for that lands with whoever owns the assets, not with whoever does the work. The richest 10% of Americans own most of the stock market, while the bottom half owns almost none. When asset prices soar, most people are watching from the outside. None of this is a glitch. The machine is doing exactly the thing it was built to do. It moves wealth from labor to assets year after year. The workers kept busy and paid just enough to keep going. It's here to stay. The vibe session is now a perma session, and the American dream is hanging by a thread. Chapter 7: The End of Progress. The American dream had a clear path. Each generation was supposed to stand a little higher than the last. A home would hold wealth that outlived you. Your children would start with more than you ever had. For the typical worker, that path is gone. The goal is no longer to get ahead, only to not fall further behind. Holding your position has become the whole ambition. The young generations inherit the worst of the deal. They have heavier debt, while milestones are pushed back. Their birth rates keep sliding toward record lows, and the reason is not some loss of desire for children. People are being priced out of having them. The typical first-time homebuyer is now 40 years old, a record high. In the 1980s, they were in their late 20s. First-timers have shrunk to just 21% of the market, the smallest share ever recorded, and many never buy at all. More and more, the home you end up with depends on the money you inherit, not on the job you work. Some escape to cheaper towns far from the workplace, but the trade is distance and the people they leave behind. The wealth gap by age tells the same story from the other end. Older owners hold homes that doubled or triple in value. Younger workers hold rent receipts and loan statements. America gave its old and its young two completely different economies. The deficit, meanwhile, refuses to sit still. The same forces that dragged an ordinary life from 40 weeks of work to 62 are still running, and it will keep climbing. There's nothing to slow it down. The economy will continue to grow. Officials will point to the strong numbers on camera, and those numbers will all be accurate. but they won't capture what people are experiencing in their daily lives, because for many households, higher incomes haven't translated into feeling ahead, only into keeping up with rising costs that move just as fast. The real question isn't about growth. It's about why a full-time year of work no longer feels like enough to cover a full-time life. A huge share of housing and wealth in the US is still concentrated into one generation that built it under very different economic conditions. When those assets begin to transfer, who actually benefits? Find out in This Will Happen After Baby Boomer Generation Dies Off. Or watch this video.
Want a professional logo or high-quality AI art? I design elite brand identities fast. DM me right now to place your order.